Hello, good afternoon, everyone. Please, can we confirm that we can hear me? Yeah, good afternoon, everyone. My name is Temitayo Jaiyeola, senior reporter with TechCabal. Welcome to this webinar by Cedar Money. Today, we're going to be discussing key cross-border trade shifts in Q1, perspectives and regulatory corridors. So, as we all know, I'll just give like a brief history, and then I'll introduce our panelists, and then we'll pick it up from there. Yeah, please, at any point you can hear me, please just let me know, so that I can just track back at any point. But like as we all know, the world is a global village, and the biggest sign of it being a global village is that I can order for something in Lagos from Ghana or Kenya and get it into Nigeria. Oh, okay, thank you, Shion. But there's still a lot of dynamics. Like I recently was speaking to somebody from Niger about cross-border payments and cross-border trade. So Nigeria and Niger have a very interesting trade. We have very interesting trade relations because a lot of what they get from Niger, they get it from us because they are landlocked, and and obviously we have a coastal line. But like for them, it's still like an headache trading with Nigeria, despite the fact that they need a lot of things from Nigeria simply because of payment. So he has a startup and is trying to solve the payments problem. And I think that what this conversation, two key things that this conversation is actually going to shine a light on and give people perspective to is geopolitics and payments. Like cross-border, despite everything that has happened, is still being shaped a lot by geopolitics and a lot of payment restrictions. And I think that one of the things that we're going to try to achieve on this webinar is we're going to try to unpack them and actually give like actionable insights and also solutions. So beyond just the talk, we would also try to see what can actually happen beyond now. So with that, and interesting, I have like very interesting experts here that they're going to be doing like justice to the matter. I have Somtochukwu, sorry about that. I have Dayo and I have Titilayo. And I think I'm going to now let the panelists introduce themselves, starting from Titi. Hi, Titilayo Ogunleye.
Good afternoon, everyone. Can you hear me, please?
Yes, Titi.
Okay, good afternoon. My name is Titilayo Ogunleye, and I lead the legal and compliance functions here at Busha.
Oh, okay. I think one thing I missed out on is, can you, like, as you're introducing yourself, you just give one key shift that you're seeing in cross-border payments. Hi, Titi, can you hear me?
Yes, I can hear you.
Oh, okay. Okay.
The biggest shift seen in cross-border trade in this year, 2026, is that coming from my field, my area of focus is compliance has moved from being a back office to a core competitive advantage, where a company's regulatory readiness is now directly dictates the access the company has to global liquidity and the speed at which the company can enter new trade corridors.
Oh, okay. Thank you, Titi. Hi, Somtochukwu.
Hi, Temitayo.
Yes, am I pronouncing your name well?
Somto, you could just call me Somto, that works. Just
okay.
Say Somto.
Oh, okay. Thank you.
Yes, so I'm Somto. I'm the country manager for Yellow Card in Nigeria. Pretty much responsible for operations in Nigeria. Yellow Card is the top cross-border payment infrastructure that helps facilitate transactions across borders riding on stable coins, and I'm privileged to serve as their country manager in Nigeria. Quick shift that I'm seeing in 2026. Then again, I see that the regulators are beginning to get interested in this market space. I see what's happening in Kenya. I see what is happening in South Africa. They're beginning to come up with, let's have a conversation with infrastructure providers like, Cedar, Yellow Card, and see how we could, come up with framework. So I see that happening already in the African market. Yeah, pretty much. Thank you.
Oh, okay. Hi, Dayo. Dayo, I'm going to put you on the spot here because, I think Somto and then TT have said, oh, yeah, around compliance and there's a bit more regulatory participation. Can you, like, I know Cedar just did something very interesting. Can you give us, like, small context? And also, what's the interesting thing, like, Nigeria specific, what is the interesting thing happening in Nigeria?
I think it's very interesting because Nigeria is and has
Dayo, please, can
always
you
been.
introduce yourself? We know Dayo,
Okay.
but like, yes.
Okay, my name is Dayo. I run the commercial function at Cedar Money. That's me. I don't think I need to talk a lot about what we do at Cedar because it will shine through as we go through in the conversation. And I think one of the main thing that I would say that has changed or is changing about cross-border trade in Nigeria, especially right in the last few months, is that there's now a lot more focus on compliance, not just in terms of the function, in terms of the overall business, focusing on it, but also the role that it plays in the future of cross-border trade, as a whole. So whether that is our partnership, our recent announced partnership with the UAE government, whether it is the government's efforts around, trade partnerships with the EU, with the US, and even China recently with Mr. Tigbe. There's a lot of compliance conversations that is weaved into all of that because Nigeria now wants to be a transparent market into the global stage. So that's what I would say has been an interesting highlight for me in the last few months. Thank you.
Oh, okay. Thank you, Dayo. Thank you, Somto. Thank you, Titi. Good afternoon again. If you're just joining us, this is Cedar Money webinar on key shifts in cross-border payment, cross-border trade for 2026. My name is Temitayo Jaiyeola. I am a senior reporter with TechCabal. So yeah, we're going to kick off from where Dayo left off. If you have any questions, you can drop them in the chat or you can raise up your hands. We're going to have a segment for questions. So, well, like you can also just drop them in the chat so that in between I could just ask the panelists. So Dayo, I think I'll kick off from where you left off, Dayo. And it's a key question for me is that we say what Nigeria is doing. Somto said what is happening across the rest of Africa, like Kenya. Titi has also mentioned regulatory compliance. But like, do you think it is time for us to start having a more coordinated conversations? Because it feels as though countries have isolated conversations, but then it's cross-border. I mean, you cannot achieve anything cross-border wise if you don't have like a more coordinated conversations. Dayo.
Okay, thanks a lot for that, Temitayo. I do agree with you. Yes, we should be having more coordinated conversations. But I think, so I suspect what you are talking about is more around intra-African trade, right? Which is about how countries within Africa trade with themselves. What is very interesting is that the Africa to the world trade corridor is actually also forcing an intra-Africa conversation in recent time. So what I have found in the last few months that we have been having conversations with our clients and prospects at Cedar is that while we are doing very well in solving problems for merchants, whether in Nigeria, in Ghana, and a few other corridors, they are bringing to us multiple other problems they have with collections, with disbursements, and things like that across multiple other countries within the continent. So even if there hasn't been a deliberate government-driven shift towards that in terms of cooperation, the technology providers, the service providers, the merchants themselves, the exporters, the importers are forcing that discussion to happen right now. So while it's not happening at the scale maybe that it should happen, it's definitely something that is happening right now. And what we have found again, as always, is that regulation always catches up with technology. So as we continue to deepen offerings, companies like Cedar, like Yellow Card, Busha, and the likes of us, we deepen our offering across these parts of the business. The regulators and the governments also will then start to realize that there's a lot of opportunity in there, and then converge with technology and then take us forward from there. Thank you.
Oh, okay. Thank you, Dayo. Somto, I would want you to add to this, consider the size of what you do.
So I agree with what Dayo said, and I think that's a fantastic question if you ask me, right? There's not just fragmentation in markets, there's also fragmentation in how we get to settle payments and whatnot, right? And it's very important because then again, if Nigeria comes up today and says, you know what, they've created a framework for Nigerians to be able to leverage stablecoins to make their payments, and Kenya comes up with that same, and maybe Ghana comes up, and maybe like a Rwanda comes up and says, you know what, we are not yet adopting this, is a problem. So it means Nigerians, Kenyans, and South Africans won't be able to make payments seamlessly using or leveraging stable coins in this market. So it makes sense that there should be some sort of collaboration amongst the markets, for there to be seamless payments leveraging on stable coins, right? We already understand that the traditional model is costing a lot of problems for businesses in terms of speed, in terms of cost, and the list is long, right? So I agree with Dayo, what he has said. Innovation can be moving fast, and if the market, in terms of the regulators in the market, do not come together and say, you know what, these guys are moving, let's not be left behind, there'll be a problem. You won't be able to make cross-border payments seamlessly, in my opinion. So what he said makes so much sense. Yeah, thank you.
Thank you, Somto. Titi, interesting thing you've said is that, regulators need to do something, like for anything to even work. What do you think is one key shift that regulators need to make for cross-border? I mean, even just beyond intra-Africa, even inter-Africa also. What was one key thing that needs to happen, one regulatory shift that needs to happen?
Thank you for that question. My first response would be that we try to harmonize our laws and our regulations based on our region. And I'll be pulling that from what we have in Europe, where we have the MICA, Market in Crypto Asset Regulation. So once you have a license from MICA, you can access 26 or 27 countries in Europe. And with that, you do not have to duplicate effort in getting license in Poland, in Portugal, in France, in Switzerland. One license grants you easy entry to all of the countries in Europe. So if regulators can come together and emulate something similar to MICA, and we have that in finance-related industry, we have it in payments, we have it in infrastructure, we also have it in the technical part that is powering the infrastructures that we have. I feel that will make cross-border trade easy business for all participants and all stakeholders.
Yeah, Titi, I was just on you, Titi, a bit, because a lot of the conversations we'll have around cross-border can actually not happen without regulation. And yes, it seems like, okay, regulators should know that this should happen, but why has it not happened? Like, why? Like, what do you think is holding it down and back, rather?
Okay, I won't be speaking for the regulators because I'm not one, but I would just say that, like Dayo mentioned, that regulation is always catching up with innovation. So I want to believe that that's the problem we have, that's the challenge we have. Innovation and technology, they move faster more than regulation. So regulation is always playing catch up. So I want to believe that's the major problem regulators have in this part of the world.
Thank you, Titi. So there's something you said about stable coins and how like important it might be. Do you like want to share light, give like more context to it, especially in light of cross-border? And what do you think are some of the things that are still holding it down, rather holding it back? Because there seems to be like a whole lot of promise, but like it's still, I think we're still just on the promise side.
That makes so much sense. I like the question. Okay, so I'll give a practical example. I don't know if everybody knows Aisho Speed. There was a time he was doing this African tour, right? And he found himself in Nigeria. I think it was Computer Village, and he tried to buy, I think it's a gadget. I can't remember what gadget it was. And when he was speaking with the merchant, you know, he asked the first question he asked the merchant was, "Do you have Cash App?" And the merchant said, "I'm in Nigeria. I don't have Cash App." Then the next question he asked was, "Do you receive USDT, USDC?" And the guy was like, "Yes." "Oh, what's your wallet?" "Oh, this is my wallet." Bam! Someone from the United States made a payment to someone in Nigeria in real time. That is practical, real life solution that stablecoins is solving, right? You can have a businessman in Kenya or in Ghana wanting to move or pay a supplier in Hong Kong or China. And the challenge is that he doesn't have, you know, the USD to be able to make that payment. And if he leverages stable coins, you know, he'll be able to make that payment in real time. So how that works is, then again, I don't know if I should go into all that many details, but it's quite straightforward. What we understand is the currency that is accepted, you know, globally is the USD, right? And a lot of people want the USD to be able to make these cross-border payments. And the closest to the USD is the stable coins, because then again, it's pegged 1-for-1 to the US dollar. So once you have stable coins, once you have that liquidity in stable coins, you'll be able to make payments to anybody in China, Hong Kong, and whatnot. So I want to pay my supplier in China, and the next thing I'm thinking of is, oh, can I, you know, reach out to the Yellow Card, go on board with them and do their compliance, whatnot, go through their KYB, KYC, generate like a wallet, then leverage on their liquidity in stable coins and make my payment to my supplier in China by just funding my Kenyan wallets with them, converting it to stable coins, and from stable coins to the merchant. So that is practical. In short, we see this in Daleko market. We have people in Computer Village, Alaba market using, in Nigeria is the largest market adoption for stable coins. And then again, you know, so there is practical examples. These are just a few to mention, right? So, and in my opinion, I want to believe that one of the things that is limiting the, you know, the use of stable coins, number one, I think there needs to be some more awareness. I think there needs to be some sort of sit and greet with the regulators, compliance guys, you know, so that, because I'll tell you what regulation would do, right? Imagine that in Nigeria, there is some sort of solid regulation backing, you know, the use of stable coins to make cross-border payments, to avoid the whole delays with the traditional payment system, right? What I would do for companies like Cedar, companies like Yellow Card, is that people would be confident to want to use them. Yellow Card in itself will be confident, or Cedar will be confident in wanting to make this transaction because they know that they are backed by the government. So if there's, so a lot of people, this business is saddled with speed, trust, you know, compliance and liquidity. If you can solve that 4 problems, you're good. So I think those are like the major concerns, in my opinion. That's my response to that.
Thank you, Somto. Thank you, Somto. Dayo, there's still, I think there's one concern that regulators keep having, and if we're going to have this conversation, I would as well just touch on it. How do we then navigate the whole currency risks? Because that's always going to be on regulators' mind. We talk about stablecoins adoption and how key it is. But like for regulators, they keep thinking about, oh, our currency risks, considering that currencies like the Naira, the cedis would always be exposed to volatility. Hi, Dayo.
Sorry, I was speaking on mute.
Okay.
So I think the one thing to track back on actually is that much more than say 24 months ago, regulators across Africa are actually embracing not just stables but also crypto in general, not as a replacement for fiat as we know it, but as one that plugs very, very visible gaps in the fiat structure that we know traditionally. So, in quotes, in defense of the regulators, Kenya has released their own crypto or virtual assets policy. Ghana has done the same. Nigeria is piloting as well across multiple functions. CBN is piloting with a few fintechs, and the NRS is starting their own in a few months. So in defense of the regulators, there's quite a lot going on in that adoption. So that fear is no longer there, as it is. What we are having to answer, like you said, is how are we sure this doesn't put our currency at risk when it comes to the value of the currency? How much pressure does it put on how much we are trying to manage the value of the currency, which in turn affects trade as a whole, for us as a country. And I think that the much more than 24 months ago, 12 months ago, the regulators are embracing this as a whole plugger more than it is a replacement. There's loads and loads of education that is also going on. One of the things that was the weakness of the tech space before was how we typically used to raise our noses against the regulators as this ignorance bunch of people who kind of like block innovation. But as that collaboration has started to improve now, and it continues to deepen, things definitely get better. We understand the perspective of the regulators better, and then of course they also understand the value of such innovations as stables, for example, the market. So I wouldn't say that we need a lot more education of the regulators, because it's not like they are that ignorant. It's just that we just need to answer a lot more questions around something touch on them: compliance, risk, AML, and then of course importantly, what is the impact of this on the overall trade markets of the country itself, which I think we are addressing now as fintechs like us continue to collaborate with these regulators.
Thank you, Dayo. Titi, hi Titi. There's something Dayo said. I was going to ask you a question around it, and I think Dayo touched on it, around compliance and how crucial compliance is going to be to changing and convincing the regulators that this is the way to go. So do you want to shed more light on that? Because this is like your thing. Do you want to just give more context to that? Thank you.
All right, thank you. So compliance to many people, it's always it's the department or the unit that always tell the business no, or like the police. However, like I mentioned earlier on, compliance has moved, it has changed. So compliance is more like a product feature you should have in your business, because it makes your business scales easily. So when I said compliance has changed, we now look at expansion. You first understand the business, and from understanding the business, you get to look at the loopholes, then you get to look at the expansion plan of the business. How can my team support the business team and also the founders of this business? Then what are the compliance points, pain points that we can help resolve? So for example, for payments now, we have issues like, for example, we are paying a company outside Nigeria, and you have to go through a correspondent bank. From the correspondent bank, you have to make sure your AML, your ESG data points that are required, they are up to date. And if there is a flag in that, that means payment is delayed. And when payment is delayed, business trade will also be delayed. So compliance is actually much more than checking KYC, checking verification, knowing who is behind the business. Is also ensuring that you are preparing your company for international expansion and also facilitating trade. So compliance to me now is more of being a revenue protector and also a business enabler, not just checking KYC documents and means of identification.
Thank you, Titi. Although, like, I still like. I mean, while you've like shared like a lot of light on compliance, there's this thing that's been happening in Nigeria. The CBN, I think towards the end of last year, early this year, they've actually been compliance has been like the song that the CBN has been singing in terms of AMTL, like anti money laundering laws and the likes. Like, yeah. But like, do you think that fragmented rules across like different borders also has a problem? Like, there's also a problem because if, for instance, in Nigeria, I know Nigeria is currently now trying to implement international border lines so that it's a lot easier. Like, if you're doing businesses with, say, like another country, another company in another country that doesn't have strict compliance rules, do you think that that creates like problems, fragmentation problems? Because seems like something that will continue to be a problem if we don't have like that collaboration.
Okay, so that's where the baseline compliance comes in. We have the Financial Action Task Force, and they have a lot of recommendations, particularly recommendation 16, which talks about travel rule, and these guides all trade transactions, which is you have to get the details of the originator of this trade and the beneficiary. So if the country Nigeria is trading with have weak or low compliance regulation, they are still bound to comply with the FATF rule, which is travel rule recommendation system. So you still have to comply with that, even though the country have maybe weak or low compliance frameworks. So we are still kind of protected. Business will still pull through because you give the basic KYC details for the recipients of this trade. However, going by the FATF rules too, then we all have this issue of grey list, blacklist, and countries that are not gray or blacklist. So, for example, those in blacklist, you will not be able to transact business with them. So if a country has been identified as not having any compliance framework, you cannot do business with them. There are some countries listed, Russia, North Korea, and all that. You won't do any form of business with them. And those with gray, you have to proceed with caution. So whether the country has low compliance framework, there is still a guardrail to hold on to, and you get protected. So that's where we have the Financial Action Task Force championing and driving compliance globally.
Thank you, Titi. Thank you so much, Titi. Dayo. Hi, Dayo. Dayo, can you hear me?
Yes, I can.
Okay, so we've said a lot about payments. We're still going to come back to payments because I don't think we can ever speak about cross-border not stay on payments because it feels like one core thing that's you slowing it down. Like, so I was reading the report by Cedar, and some interesting things jumped at me. Yeah, we all know that America is changing. The way America is changing its relationship with the world is changing how the world is relating with America and how the world is relating with itself. And this means that for continents like Africa, we're rethinking trade, we're rethinking new corridors. And your report actually touched on that. Do you want to give context? Like, just like, say like 2 minutes, just give like what are new trade corridors that we're saying now that the world is rethinking its strategy?
Thank you very much for that, Temitayo. I think the main conversation, like you said, is it's not just Africa that is impacted, but the world in general is basically changing how it looks at trade and who are the major drivers of trade across the world. So I would say 10, 20 years ago, America and the EU were the largest trade corridors, and everyone, if you weren't trading with these two corridors, you basically were losing out in the world of global trade. But with the advent of China and the growth of China in the last 20 years, China has fast become like the biggest corridor from Africa, right? The other thing that has now happened with all of the trade wars between, so the US and China are always at trade loggerheads. So often we who our currencies are often pegged against the USD are caught in between that trade war oftentimes. The other corridors that are building out of that, for example, is the Africa-Asia corridor, which is actually Africa-Asia-China in some cases, or is Africa-Asia, is Asia-Asia, Asia-Latam that are now also building up to kind of pushing the effect of these trade wars. So for example, you would find that one of the biggest corridors that is emerging right now for Africa, Nigeria especially, is the UAE as one. So you are finding exporters and importers, right, who are then using this corridor as like the aggregator corridor for multiple goods and products that they will typically buy from China or from the US. So a lot of what is happening, and I think is good, right? Because the world is now having to think very critically about how it is working as a whole. Now, apart from those trade corridors opening up, what that also helps us to do is also to ensure that even these new corridors are now having to also deepen their, AML compliance frameworks and things like that. So Dubai, for example, the UAE, for example, was on the FATF grey list till I think 2024 or so. And there's a new review later this year. So they are still very strict around, compliance now and how they view compliance, because they think that they can take advantage of the global trade wars. So I think just to summarize, what we are doing as Cedar and what we are seeing is that there's also now a lot of concentration across alternative corridors to say the EU and the US, and even to now China. So while China is still big, less and less merchants and importers out of Africa are trading directly with China. Instead now, they'll rather go through some country in Asia and most recently the UAE. Thank you.
Thank you, Dayo. But before I let you go on this question, and I'll bring Somto on, what do you think are like so many opportunities for, say, importers and exporters, like especially from, I don't want it to be Nigerian centric, but like, yeah, you can touch on Nigeria. Yeah.
So and Nigeria keeps popping up because of the sheer volume of trade that we do. So typically when you are talking sub-Saharan Africa, the Nigerian behavior across trade usually is mirrored across Africa, even though the specific dynamics would be different across multiple countries. I tried to mention an example of what I have found recently, or what we have found in market recently, which is especially for the FMCG space. A lot of these guys who bring in high volume, high frequency shipments into Africa have now kind of centered on the Asian corridor as an option to even China, right? What this helps them do is it protects them, on the currency side, right? The dirham, for example, is a stable currency. The corridor collects in USD as well. There's the whole free trade zone as well. So basically, these industries that are very, very low margin, right, are then having to then play in these kinds of corridors where they can get more for their treasury pay, right? So if I would spend even an extra naira sending directly to China and importing from China, why don't I just do it through the UAE? So these are the kinds of needs that are now driving those corridors. So if you think of the likes of Rene, supermarkets, Ebano, loads of these guys now we are finding in markets that their largest corridors of import these days actually come from the UAE. And this is because, their margins are low, the business is very high treasury. They have much better financing options across those corridors as well. So I would say that that's a direct impact across African businesses who are heavy on imports. Thank you.
Thank you so much, Dayo. Hi, Somto.
Hi, Temitayo.
Yes. Yeah. So we're seeing the opportunities, we're seeing new corridors, but what does this mean for settlement patterns and for liquidity?
Okay, that's a fantastic question. So, then again, I like to speak from an operational standpoint. And what is liquidity? Liquidity is availability of cash. I think I touched on this when I was talking about why stable coins, right? And what this means is, I'll just give an example, right? And the example that I'm going to give is somewhat touching on, an example I've given before. So let me use Ghana, for instance. I have, let's say 1 billion Ghana cedis, and I want to pay supplier in China, right? Now I have that local currency, I have that fiat, but I need, like I said, the universal currency that has been accepted is USD. And I need to be able to pay this guy in China, and I have 1 billion cedis. How am I going to do that, right? All I need to do is look for liquidity, and liquidity is the USD to be able to pay that, because then again, in China, they would accept, USD. But there is an equivalent to that. So there's an equivalent to USD, and that's stable coins, and my ability to be able to leverage platforms that I can use stable coins to make this payment with is key, right? So I reach out to a company like Cedar, I reach out to a company like Yellowcard, and I tell them that, you know what, I have this volume, I want to be able to pay my supplier, I need liquidity, I need access to liquidity. I think the beautiful thing, I'll tell you this for free, there's something Yellowcard has built, it's called Treasury Portal, right? And I like to call it the self-service portal, where a merchant or a customer can come on there, a business rather can come on there, and you know what, it has the features for you to manage your treasury, it has the features for you to consummate transaction, it has the features for you, it has compliance inbuilt in there. I know Titi touched on that. It has compliance in settlements inbuilt in there. So imagine I am that guy in Ghana trying to pay my supplier, and I am on a treasury portal that has so there's no fragmentation. I'm not looking for a platform that will help me with settlement. I'm not looking for a platform that will help me with the cross-border payment. I'm not looking for a platform that will help me with the FX. I'm not looking I already have a platform that would help me solve my payments and settle, and so it is the world is shifted, and players on the market, importers, or the oil and gas sector, I want to believe that it is time that they begin to leverage payment infrastructures that can help them settle in real time. Now, all this in one bucket, and you'll be able to make a transaction seamlessly. So that's my response to you.
Thank you so much, though. Although there's something you said, and I was going to ask, and maybe I'll just ask you on Dayo, if I go to TT, is yes, stablecoin interesting, and for like a lot of small startups and small businesses, they would definitely jump on it. But for legacy businesses, what do you think are some of like the biggest constraints? Why are they not there yet? Because it feels like if legacy doesn't adopt, there wouldn't necessarily be mass adoption.
Oh yeah, so that's a fantastic question, by the way. One of the major constraints with legacy businesses and businesses that would do serious volumes is that, then again, there is a lot of structure in place, a lot of policy within their own structure that would, for example, if we want to onboard, I don't want to mention any name, but let's assume one of these, like we want to onboard one of them, it goes through a lot of cadence, this approval, that approval, this approval, but the good thing is the moment one of them gets onboarded, everybody everybody in this space would want. For example, you look at partnered with Visa. Yeah, that took a while, but it happened. And, we're already seeing that these legacy organizations are wanting to, jump on board. MasterCard is announcing that, they want to start leveraging stable coins. Western Union is having conversations around. See, the big guys are already wanting to adopt stable coins, right? And I think more of them should, look into this space and, start having internal conversations with themselves on how to leverage stable coins, in my opinion. So yes, I think it's about time. Now is the time for them to, consider to wanting to, because then again, there's a lot, you want to make a transaction and you're dealing with the Form M's, you're dealing with the delays in transaction, you want payments to be done within 24 hours and it's taking 72 hours. You don't want all that. And you're a big corporation, right? You want to be able to make your payment in real time. You want to be able to, and this, what it will do for your business is that it's going to build trust for your business. And it's going to save you a lot of time cost, in my opinion. So that's my response to you,
Thank you so much. So, Dayo. Hi, Dayo.
Yeah, hi. Hi,
Yeah. The question was to you too. Yeah.
Okay, so I would even wager that the big businesses on paper do not care whether it's stables or it's fiat, right? These are just instruments. What they really, really care about is that they are making USD denominated payments, basically, right? So, for example, we have quite a lot of these big businesses on file right now. We have competitors who have them on file. They are not going into the nitty-gritty of, or how are you making my payments? Are you collecting dollars in cash, or is it inflow? The question is, are you making my payments? So much more than we actually know, the big businesses are actually getting on board on stables, but they are getting on board from a service standpoint, which is, I need to pay my suppliers. There's a need for $5 million, $10 million. There's no liquidity issues. It is fast, it is compliant, and I can get my actual SWIFT document without any issues. And once that is solved, I have found that adoption in quotes for them has not been a problem, at least on the payment side. Now, if we start talking about them managing their own internal liquidity and treasury and use of stablecoins, it's a completely different ballgame, because that is then driven a little bit around regulation as well. So it's more a fear or concern around regulation than it is about the stablecoin system itself. From them. And on that one, it's a journey, right? As the country itself improves. Somto already talked about the global shifts. So we too won't have a choice. We have to shift. Like I said, the CBN is running a pilot with a few fintechs right now. The NRS is starting theirs, SEC as well. So there's a lot of activity going on around the value assets regulatory agency or authority thing that is going on in Nigeria. So I think that the adoption is actually imminent across countries in Africa, not just in Nigeria. Ghana has released theirs, Kenya has, Tanzania, that it was a no before, are having conversations as well. So it's definitely evolving. So if we are talking about treasury, it's driven by regulation. If you're talking about payments, that is not for them a problem. As long as you can deliver it compliantly, safely, and on time. I don't think they really care about that. Thank you.
Thank you, Dayo. Titi, hi Titi.
Hello, Tayo.
Yeah, could you answer this question from like a compliance point of view? Because one thing I know about legacy is compliance levels are usually very, very strict and higher. Did you get that?
No, please.
Yeah. I said, could you, like the question I asked them, Dayo and Somto, around legacy companies adopting stable coins, especially for payment for cross-border. Like if you wanted to answer it from like a compliance lens, what would be your own point of view?
Okay, thank you for that. So legacy companies adopting stablecoin is more like them catching up with the innovation. So I'll just paint a scenario from the operations point of view, which is when you're trying to make a cross-border payment, back then going through the commercial banks, the legacy banks that we have now. It always takes like 5 to 10 days, go through SWIFT and all that. But right now you can make this payment through stablecoin, USDT, USDC, or even use CGN if it's within Nigeria, and you get that done in minutes, not even up to an hour, no matter the transaction, no matter the value of the transaction. So the legacy companies adopting stablecoin is because they see that this is the future of payment, and they also see the ease at doing business that stablecoins brings, and they also see that for treasuring, you are able to get USD, you're able to get FX at a rate that you can even secure for the future. For example, USDT is pegged to $1. So you can source for USDT before you have a need, and you have that in your reserve. Unlike when they used to source for USD as a just-in-time need. So I see the shift to stablecoin because we know that it brings solution. One, it's safe. That's one, and that's the second one. It is reliable, and there is little or no human intervention required. So by saying that, you see a situation whereby for you to ship in commodities back then, you have to send bill of lading, you have to send it by maybe DHL or FedEx or UPS back then. It takes like 5 days. Then when you receive it, that's when you can now ship your order out. But now you can use smart contracts for that, which is once a digital bill of lading is submitted, you can automate payment immediately. So when you know that life is easy, why do you have to go through the traditional way of banking? And with smart contracts, the good thing about it is it's also on the DLT. We call it DLT, distributed ledger technology. Everybody can monitor it, both the seller, both the buyer, even the banks. They can monitor it. You see the transaction moving, so there is safety. And compliance too is also embedded into this, because smart contract is a form of compliance, which is, for example, for you to move from a tier 1 bank account to a tier 2 bank account, you have to bring your utility bill, or you have to bring your BVN or something like that. I'm talking about traditional banking. But in smart contracts, you just have a rule, which is once the bill of lading is submitted, payment can be processed immediately. That is compliance. You do not have to go through the rigorous checking books, pages upon pages. This makes life easy and is automated. So I see that's why legacy companies are accepting stable coins, and we are looking forward to more adoption by the legacy companies. That's my response for the compliance part.
Thank you, Titi. From a compliance point too, because you are a compliance person on board here. What do you think businesses? I mean, with shift happening cross-border, what do you think businesses should be doing differently in 2026?
Okay, I think businesses in 2026, I think they should start thinking of, especially treasury departments in business. They should start thinking of the treasury department as an expansion tool. They should optimize treasury with digital rails. They should onboard customers in new countries faster using digital rails, because you already solved the how do we get paid problem once you have a digital rail embedded in your solution. Then you should stop viewing FX as an unavoidable sunk cost, which you see it as a logistic failure. So if it's a logistics failure, that means you are losing like a percentage on every transfer you make every day, and you're also losing this in settlement. So once you know that this is a logistic failure, you want to find a solution, and the finding solution is rethinking the role of compliance, which is the compliance department is how do we solve this problem in a fragmented trade world. Your compliance data is your passport. Because if Busha is trying to on board with, like Somto mentioned, Visa, MasterCard, what they'll be asking us is, why are your AML policy? Where are your sanction policy? Who is your KYC solution provider? How do you monitor transaction? What is the threshold of payment per day, per week, and per month? You should have all of this documented. These are compliance data, and this is what we make passporting to other countries easy for you. So your compliance data is your passport. So if you have a clean digital compliance workflows, you're already pre-approved for a global trade. You're already positioned for a global trade. And one thing I've realized in this 2026 so far is, like Dayo mentioned, the Nigeria UAE corridor, it has shown me that trade move at the speed of trust, right? But expansion move at the speed of settlement. And if expansion move at the speed of settlement, that means you have to talk about regulations on those corridors. And at the end of the day, your business will only grow and become more reliable when you adopt compliance, regulation, and see compliance as a product future. This is my takeaway from this first quarter of 2026.
Thank you. Thank you so much, Titi. Somto, the actually same question at you, but from a payment point of view.
Fantastic. Okay, so this is what I see for the future, and I strongly believe, and then again, you can't rule out regulation, you can't rule out compliance for this to even happen. I see a future in 2026 where the banks are now wanting to handshake with, companies like Cedar, companies like Yellow Card, with the help of the CBN and, the other regulatory body SEC that, regulates this. Imagine the challenges that is faced when you want to use the banks to make a payment, right? That's from an operational standpoint. And imagine the banks now leverage, partnering with companies like Cedar or companies like Yellow Card to help facilitate cross-border payments. That is going to be amazing, because then again, you can't rule out the importance of, the banking rails in making this cross-border payment, right? So once there is that sort of, I see a future where, the regulatory bodies would come up with, and this is, I dare say it's wishful thinking, but it's possible, and it's already happening, right? Where, the banks would wake up and say, you know what, these guys, what are they doing? How can we, collaborate with them? How can we have them have their infrastructure embedded in our own infrastructure to facilitate payment? That's what I see. And it will make settlement faster. Then for companies that, like what Yellow Card is doing, I mentioned, we have created something that affords you in real time. It's self-service. Everything in it, when it comes to cross-border payment, settlement, compliance, everything is in one cadence. You want to do like some sort of conversion, everything is in one cadence. So you take your Nigerian wallet, convert to stable coins, and from stable coins to wherever, whatever country you want to pay. So that's what I see for organizations as well in this space. So the first one, banks collaborating with us or other payment channels having some sort of collaboration where, it is the adoption becomes, massive. And for organizations in this space, tweaking the innovation and creating, better infrastructure that would afford for speed in this space. So yeah, I hope that answers your question.
Yeah, thank you so much, Somto. Dayo, same question also from like a payment POV.
Okay, so I think Somto and Titilayo have done a good job around this conversation, and maybe the only thing that I would add would be around, just to buttress what Somto was saying, around convergence, because no one is getting replaced in that sense. At the end of the day, it's the future I see is a future where there's increasing collaboration across what is currently the digital world and the traditional banking world eventually. And on top of that, what is important is that those that are going to survive, again, back to compliance, are those who have built that infrastructure to survive. So typically, you find, apart from availability of FX, one main reason why businesses, flow into stables and fintechs and all of that is the compliance requirements, the rigidity, so while stables have offered a much better approach, an easier approach for the businesses, it's not a non-compliant approach. So as compliance deepens on that side, and banks are now start to bank more and more stablecoin providers, the businesses also will need to also align a lot much more and more around being built, to be compliant, whether they are importers or exporters, because the more the world can see of you, the more they can trust you, and you can build that real. So I think the future is in convergence. It's in a hybrid world where everyone works together side by side, and also in an interconnected manner. Thank you very much.
Thank you, Dayo. I'll quickly take a couple of questions from the audience, from participants, and if we still have time for maybe one or two questions, I'll just give it. Masha has a question around stablecoins. I think probably I'll direct this at Somto, then maybe Dayo will just add something. Masha says, while stablecoins have been presented as a solution for fragmentation, but which corridors really have enough depth today for a merchant to actually rely on them at scale without spillage risks? Somto.
Yeah, can you take the question again? There is an interference. The plane is passing.
Oh, okay.
Yeah.
Okay. So while stablecoins have been presented as a solution to fragmentation, stablecoins liquidity on the African corridor is still itself fragmented. So currently, which corridors have enough depth today for a merchant to actually rely on them at scale without spillage risks?
Oh, fantastic question. I think Dayo mentioned and spoke about this when he talked about the UAE Africa corridor, right? And he also talked about corridors that are expanding, like Africa, Asia, that's delegate Africa, India. We see a lot of transactions being consummated from Dubai, from India, from China, from Hong Kong. A lot of people reaching out to us saying, they want to make some sort of payment to settle. There's a lot of businesses in Asia, and I think they're quite flexible. So those corridors are quite of like the option that you can consider to use, right? And then again, within Africa, Kenya, South Africa, we have a lot. So South Africa, they've embraced, in my opinion, they've embraced stable coins, and they've come up with, framework that helps the economy. So, so those are corridors that you could consider. I hope that answers your question.
Okay, Masha, Dayo, you also had something to Masha's question.
Yes. So just to say that in terms of actual stablecoin liquidity, the real problem isn't the actual stablecoin liquidity, because whether you are in Nigeria or Tanzania or further south in Mozambique or wherever, there's not much of a problem with stablecoin liquidity. What we have an issue with is the availability of local liquidity and how we convert that into stables, right? And that is a problem of infrastructure across various corridors within Africa, which, so French Africa is one that they're looking to solve. There are countries within Africa as well that have very, very, very strict FX policies that also make that difficult. So it's not exactly a stablecoin liquidity problem. It's a local liquidity issue around even how local fiat or local currencies relate with FX in general, not just stablecoins. So as the governments open up even further, it then helps us to be able to integrate stablecoins into the services across those countries, across Africa as well. Thank you.
Oh, hi, Titi. I know you want to add something to this. So I guess I'll just ask you Juliana's question, and you just take the two, because I think we've actually run out of time. So Juliana's question is around how like, yeah, we're speaking a lot about African stablecoin regulation, but like, are we likely to see like, which seems very fragmented currently, but are we likely to see major regulators work together to develop like a proper cross-border licensing framework, like we are seeing in Europe?
Okay, thank you for that. We'll first answer the last question, which is the corridors. There is a second question to it, which is the slippage risk, which I'm more interested in responding to. I understand the merchants, they have this phobia for slippage, and in the digital asset or virtual asset space, I think I see that happening or occurring when merchants focus more on retail liquidity. I mean, retail grade liquidity like P2P or small scale exchanges. However, for you to avoid slippage risk, your business needs to scale. You need to move from retail grade liquidity to an institutional grade infrastructure. And when I say institutional grade infrastructure, you go for the licensed infrastructure providers for stability and for stablecoin liquidity. And when you have that, you won't have to rely on fragmented local pools, because those that are licensed and they have this infrastructure, they already have the likes of a proof of reserve, which were all put in when they were applying for their license from the SEC. That's one thing about Busha that we did when we secured our license from this Securities and Exchange Commission. You have your proof of reserve, you have the fidelity bond, you ensure that you have minimum share capital. So when you have a licensed infrastructure provider powering your stablecoin, you won't experience slippage risk. I believe that answers the first question. Then to the second question, the issue of African adopting a joint stablecoin or harmonizing stablecoin at the continent level. I mentioned it earlier when I said in Europe there is something similar to that. They have MiCA, which is Market in Crypto Assets Regulations, which covers all the states, all the countries in Europe. Like that's 27 countries. So one license in one country, you use that in passporting to other countries. And I see that Africa will get to that point because I know there is South Africa that is championing stablecoin in Africa. We have Nigeria, we have Kenya. And with the recent passporting that we have between Kenya and Rwanda and Ghana for PSP, I see that virtual assets will soon get to that level, will soon get to that stage. It might take time, but it's something that I envisage happening anytime soon.
Thank you, Titi. So Titi, I'll just quickly ask a follow-up question from Marsha.
Okay.
So that I think the last question will be directed at Somto and Dayo. So are legacy institutions adopting stablecoins in a way that threatens the P2P and OTC layer or validates it?
Okay, so legacy institutions adopting stablecoin, I do not see it as a threat to OTC layer or P2P. Busha, we do not engage in P2P, so I will not be able to talk from the operational point of view for P2P. For OTC, I will not also be able to talk about that. But what I understand about OTC is there are different rates. I know that there are different rates for exchange for fiat to stablecoin. I do not see legacy institution being a threat to an established business. So if you're a licensed, like I mentioned initially, you're a licensed solution provider and you have your proof of reserve, you have your fidelity bond, you have where you can draw support and liquidity from. I do not see the legacy institution being a threat to you. Rather, they are going to play catching up with you. And also ensure that in all you do not treat compliance as a checkbox. Rather, you see it as an enabler of your business.
Thank you. Thank you, Titi. Thank you so much, Titi. Somto and Dayo, a final question from Marsha. Marsha wants to know if with the Africa and UAE corridor getting attention, is it genuinely a new payment infrastructure, or businesses just routing through UAE to access dollar liquidity they can't get directly? And also what changes when that workaround gets regulated? Somtochukwu, sorry, did you get the question?
Yes, yes.
Okay.
Somto, do you want to go? Or should I?
Dayo, please go. I just got distracted.
Okay. So look, what drives infrastructure growth is demand, right? So there's no isolation between routing trade through a corridor and the building of the infrastructure. And that's why I mentioned earlier the work that the UAE government is doing right now, to basically solidify their reputation as a trusted corridor for this. So I don't think there's any issues around that. It's a corridor that has definitely come to stay. Now, on the infrastructure side, yes, the demand is definitely faster than the infrastructure, right? It's the same thing that happened with China. China grew and grew and grew and grew, and then all of us started to focus on China, and now we have like multiple rails, multiple solutions for China. It's the same thing, So there's increasingly tech providers who are now focused on liquidity in and out of the UAE, and that is going to continue to grow. Whether that is fiat liquidity, whether that is digital, it's going to continue to grow and solidify. And like Somto also mentioned earlier, it's not just the UAE, it's also India. And these things will continue to grow and give options for trade across the world in the near future. Thank you.
Thank you so much, Dayo. Thank you so much, everyone, for joining us. Dayo, just on the final one, this is a question, and it's more about the white paper that Cedar just published. Do you want to say one or two things about it? Then we round up. Because a lot of what we've said today, there's been like it's kind of like spinned off like a lot of like your research on the white paper.
Yeah. So I think the summary is we've spoken quite a lot around the main points of the white paper. While there's a lot of focus on UAE corridor, it's not just the UAE, it's also a global trade phenomenon. So basically, the world is getting smarter. We are doing much more with using different sorts of infrastructure. And I think the biggest part of that is that we continue to build compliance infrastructure, not just the technology infrastructure in terms of just being able to be connected, but also being connected in a way that Africa is trusted across the world from a compliance standpoint. I think we will share links to that to everyone who is on this call, and you can get more detail from the white by itself. Thank you. Somto.
Thank you, Dayo. Somto.
Yeah, thank you, Dayo. I got a call and it distracted me a bit. Okay, so to answer that question, and I think Dayo has already done justice to it. In my opinion, then again, if you look at the blueprint for the UAE, they are very clear. Countries like Qatar, they are very clear on innovation. It's clear that they want to be the first movers when it comes to when it comes to anything innovation, right? And stablecoins, in my opinion, serves as an innovation tool, right? So I believe that genuinely, they have devised means to allow their corridors to be able to facilitate this payment, and businesses has identified this and have started wanting to churn that route to use the UAE to make transactions. The other part is what then happens. Is there a workaround around regulation? Then again, I think Titi is the best person to answer this question, right? But you cannot rule out regulation, and I don't think that the corridor is a threat to regulation. I think there is a clear solution that stablecoins are solving, whether it be the UAE, whether it be Asia, whether it be Africa. There's a clear solution that, and we've said this, and we've said this time without number. It's about that time that regulation should come and investigate what are these guys doing, how can we be part of it, how can we come up with frameworks that will make it work so that everybody will be satisfied, both merchants and both businesses that want to adopt stable coins, and for us that provide infrastructure infrastructure as well, will be confident enough to say, you know what, we are seeing that UAE has opened its corridors. You guys can now use our infrastructure to make your payment. So the conversation it can go on and on and on, but I just wanted to add that. Thank you.
Thank you so much, Somto. Thank you so much, Dayo. Thank you so much, TT. And thank you so much to everyone that joined. The conversation never really ends. So yes, well, this webinar is ending now. The conversation never really ends. Do have a lovely rest of your day. Thank you so much.
Thank you, everyone.
Thank you, everyone.